Put the snack down, mute every notification. If someone's yelling in the other room, they can wait 5 minutes. I want you fully here for this. Because what I'm about to walk you through is not a movie script. It's a possible financial scenario built from how real markets behave when they're stressed to the breaking point. Before we go any further, lock this in. This is education and opinion, not a prediction. This is not personal financial advice. I'm not your advisor, I don't know your situation, and I'm not telling you what to buy or sell. What I am going to do is show you, step by step, how a quiet structural shift in one tiny corner of the market, silver, could snowball into a war between East and West over real metal, a complete reversal by the very banks everyone thought were the villains, and a moment where regular people discover they've been quietly pushed out of the game. If any version of this ever starts to happen in real life, I want you to recognize the signs before you're the last one standing outside looking through the glass. Ready? Let's time travel a little bit. Imagine it's a normal weekday morning in the near future. You roll over, grab your phone, and open whatever app you check first. Maybe stocks, maybe crypto, maybe just the news. You see a number and your half-awake brain doesn't compute it. Silver 97.40, you blink, you refresh. You think your app glitched. Last time you really looked at silver, it was boring at 22. Maybe it had spiked to 30 once or twice, and every YouTube dude screaming, 100 zone, looked like a cartoon character. Now your screen is calmly telling you the boring metal just did more in a few months than it did in the last decade. You open another app just to sanity check. Same thing. Spot silver around 97 to 100 in New York. Then you scroll to see what Asia is doing. Shanghai. The equivalent price there is 112, not a few cents, not a dollar. Double-digit dollars higher than the US paper price. News feeds are full of phrases like, physical premium explodes in Asia, Eastern buyers outbidding Western futures market, traders stunned at disconnect. Here's the key question nobody on TV is answering clearly. How can the same metal have two totally different prices depending on which side of the planet you're on? The simple version, in New York, you mostly have contracts, promises to deliver in the future. In Shanghai and in physical markets, you have metal, real bars and coins changing hands. When real-world users, refiners, mints, solar panel makers, electronics giants are hungry for the metal, they'll pay up for the stuff, even if some screen somewhere still says it's worth less. That price gap is like a warning light on the dashboard. The financial system's paper story about silver and the real-world story about silver are starting to argue with each other. And that's where the real drama begins. Now add this twist. For more than a decade, silver bugs on the internet have been obsessed with one villain, a massive, household name US bank that, according to public positioning data and multiple investigations, has often been short silver, betting against higher prices, leaning on rallies, allegedly managing the market. For years, the story went like this. Every big spike in silver, Guy appears out of nowhere, stalls under some ceiling, and immediately runs into a wall of selling. To the average retail trader, it looked like magic. To anyone who's ever watched a thin market under the thumb of big players, it looked like a handful of giants constantly fading the upside. Now imagine, in this future moment you're looking at, someone starts combing through fresh data, option flows, and subtle changes in market structure. And a pattern emerges. The bank that used to be the anchor on the market is no longer leaning on prices. In fact, over months of wild volatility, they've done something only pros can really pull off. They've used every panic, every flash crash, every manipulated looking downdraft to quietly buy back their short positions at cheaper levels, and then, once flat, they kept right on buying, only this time on the long side. How do you hide an elephant buying silver? You make the whole jungle stampede first. Picture one of those brutal afternoons on the chart. Sentiment is euphoric. Then, out of nowhere, the price gets hit with a tidal wave of selling. To 102 to 95 to 88, stop losses fire. Margin calls explode. Social media flips from, we're rich, to they killed the rally in an hour. But then you notice something. Instead of crashing back to 60s or 50, the price freezes in the high 80s. Volume is huge. The tape is thick. It's as if there's an invisible vacuum cleaner under the market, inhaling every forced sale, every panic dump, every over-leveraged exit. That's how a large short position dies. Not with a gentle fade, but with a controlled detonation. They smash price down with paper selling, they trigger mass liquidation, and then they are the ones quietly buying all that forced selling to close out their obligations. Once the book is flat, no more huge short bet, they don't have to keep capping rallies to protect themselves. If they go a step further and start owning a mountain of physical metal, their incentives flip 180 degrees, they stop being the ceiling, they quietly become the floor. Now, let's look at what's happening at the ground level while this predator changes sides. You, me, regular people. We don't call the refinery. We don't wire for 200,000 ounces. We buy silver the normal way, coins and bars from online dealers, local shops, maybe a few trusted mints. In our scenario, as the price explodes and that east-west gap widens, you start hearing weird things from those dealers. One big US site updates their homepage. Due to unprecedented demand and limited refinery allocations, minimum new silver order $10,000. Another posts, Radel silver products temporarily unavailable. Institutional inquiries only. Your local coin shop that used to have trays of rounds and bars in the window. Now they've got empty display cases, a sign that says CL FAR AVI Love IOI, and the owner telling you he can't promise anything beyond a couple of junk bags. Maybe. Meanwhile, if you dig a little deeper, you hear mint executives and wholesale dealers on industry calls saying things like, "We're booked out months ahead on industrial orders. Priority is going to long-term institutional partners. We simply don't have the capacity to fill small tickets right now." Translated into plain English, the club is full. If you're not a whale, you're waiting outside. This is what a retail lockout looks like in practice. You finally wake up and decide, I want a real piece of this. You log in, ready to buy 10, 20, maybe 50 ounces. And the system shrugs and says, sorry, minimum cover charge is 5 figures now. The irony, while you're being told, come back later, that same supply chain is bending over backwards to fill enormous orders from large funds hedging macro risk, corporations nervous about future input costs, and yes, banks that just quietly abandoned the short side and now want a fortress made of real metal. The elevator doors didn't slam shut when silver was cheap and boring. They're closing now, halfway up the shaft, while the music is getting louder and the crowd is just realizing there is a party. If this was just about a collectible metal, none of this would matter. The real fuel behind a move like this isn't memes. It's math and geopolitics. Let's lay out the pressures stacking on top of each other in this scenario. Industrial hunger. Silver is not just a poor man's gold. It's wired into solar panels, electric vehicles, high-end electronics, medical equipment, critical military tech. As countries race to go green and digitize everything, their silver needs don't go down. They go up. East vs West supply tug of war. Big manufacturing nations lock in long-term contracts. Some tighten export rules on refined silver or scrap. Once metal flows in, much less flows back out. Over time, more of the world's accessible above-ground silver is sitting in Eastern vaults, not Western warehouses. A slow confidence leak in currencies. Government debt keeps climbing. Deficits become permanent, not temporary. Central banks bounce between fighting inflation and bailing out markets. Foreign buyers gently step back from holding as many U.S. treasuries. No one pushes a big red collapse button. They just gradually say, maybe we want more of our reserves in things no one can print. Regulatory and political risk sanctions. Frozen central bank reserves. Weaponization of payment rails. If you're a country not fully aligned with U.S. policy, you read those headlines and think, we need more gold, more silver, more commodities under our own control. Add those together and you get a powerful incentive for non-Western players to bid aggressively for physical silver, pay premiums over official Western prices, and hold that metal tight. When that wave eventually collides with a Western futures market used to rolling paper contracts and never worrying about actual delivery, you get tension. And out of all the big Western institutions, who's the first to smell that turning tide? The ones with the deepest market intelligence. The same banks that used to profit off the old pattern. They're not sentimental. They're not ideological. They see, we are entering a world where being massively short real stuff is suicidal. So they move, quietly, early. They swap paper promises for tangible insurance. That's what a short to long flip really is in this context: a vote against infinite IOUs and a vote for finite atoms. Let's stitch it together in a rough timeline. Again, this is a scenario, not a prophecy. I'm painting a picture of how it could happen, not declaring that it will. Phase 1, the slow creep. Silver starts grinding higher from, say, the low 20s to the 30s. You see choppy spikes and violent pullbacks. People call each move the top, then get confused when new buyers show up. Positioning data, for those who watch it, quietly shows big commercial shorts shrinking. Phase 2, the first shock, a geopolitical flare-up, an energy crunch, or a surprise central bank move sparks a bigger run. Silver punches through old highs convincingly. Levels like 30 or 35, the four data get cleared and stay cleared. Suddenly everyone remembers 2011 and starts dusting off old narratives. Eastern demand ramps up, the Asia-West premium starts to widen. Phase 3, the accidental crash just as sentiment goes greedy, a massive wave of selling slams the price intraday. 60 OPLUF to low 50s or 90 OPLUF to high 70s. Pick your numbers. Social media screams, manipulation. The majority reacts emotionally and either panic sells or rage buys. Behind the curtain, that's the moment the largest short positions get cleaned up. The big players use the chaos to exit their old bets and quietly build new ones in the opposite direction. Phase 4, the grind higher, with no real sell-offs after that event. Something changes in character. Every time price dips, you can almost feel a heavy, invisible hand supporting it. The market stops crashing all the way back. It starts making higher lows over and over. Physical product becomes harder to find at anything near spot. Dealers extend delivery times. Minimum orders creep higher. Retail is still mostly thinking like traders. I'll sell this spike and buy back lower. It always comes back down. But now the dominant players don't want it to come back down. Phase 5, mainstream attention and late FOMO. Major business networks start running segments on the silver shock. Big-name hedge fund managers suddenly start talking about metals on podcasts. Tech CEOs and industrial giants begin hinting on calls that they're diversifying supply chains and considering strategic inventories. Suddenly, your friend who laughed at you for owning a few coins is texting, "Bro, is it too late to buy silver?" At the same time, websites that used to ship it to your door in 3 days now say, "Out of stock," or 6 to 8 weeks delivery, or minimum order 500,000. Phase 6, the vertical and the void at a certain critical point, the physical market buckles. A delivery default, a major mint shutdown, a failed industrial contract, something breaks in public. That event becomes the excuse for the next leg of the squeeze. Price doesn't just trend, it lurches. The 2030 jumps in days, not months. In that chaos, most small investors do exactly what their emotions tell them. They chase way too high with money they can't afford to lose, or they get shaken out by volatility on the way up, or they're simply locked out by lack of supply. The ones who tend to come out whole understood the structure early, didn't bet the rent, and weren't relying on daily reassurance from a green candle. Again, none of this is guaranteed, but it's closer to how big trends actually unfold than the straight line up fantasy people love to imagine. Let's talk about the part nobody likes to confront: anger. If you've been following this space for a while, the idea that the same institutions accused of suppressing silver for years might now profit wildly on the upside feels infuriating. They leaned on the market when it suited them. They got fined small percentages of their gains. And now, in this scenario, they flip sides and ride the very wave stackers have been dreaming about. It feels like watching the arsonist get hired as the fire chief. You might think, if they're going to make billions on this, I want nothing to do with it. I'll sell out of pure spite. Here's the hard truth from a market perspective: your anger doesn't cost them money. Your emotionally driven trades feed them liquidity. They don't care why you hit the button, just that you do. Whether we're talking silver, stocks, crypto, or houses, the pattern is always the same. Retail loves to swear, "Never again," then gets sucked back in at the next emotional extreme without ever really understanding the mechanics in the middle. So what do you actually do with all this? I'm not going to tell you, buy now or sell now. I'm not sitting across from you. I don't know your bank account, your job, your obligations, or your risk tolerance. Here's what I will tell you: know what game you're in. Are you a trader chasing short-term moves, or a long-term allocator who wants some exposure to hard assets as a hedge? Those are totally different games with different rules. Size like a grown-up. If a 30-50% drawdown in something makes you physically ill, your position is probably too big. Silver is historically volatile. Expect roller coasters, not escalators. Understand the role of physical vest paper futures, ETFs, mining stocks, all behave differently from coins and bars in your hand. In a genuine physical squeeze, some of those vehicles may not track each other cleanly. Watch behavior, not just price. Do dips keep getting bought? Are big players consistently reducing shorts over time? Are premiums for real metal staying elevated even when futures sag? Refuse to trade on pure rage or FOMO. I'm buying because I'm mad at the banks, and I'm buying because I'm scared I'll miss out, are both terrible strategies. I'm making a measured decision based on my plan is boring and powerful. The uncomfortable but liberating reality is this: you cannot control what giant institutions do. You can control how informed you are when they do it. If a day ever comes when silver is ripping, east and west prices are miles apart, retail is being quietly squeezed out, and the sharks have clearly swum to the other side of the pool, I don't want you paralyzed or blindsided or clicking buy or sell in a blind panic. I want you saying, "I've seen this movie before. I understand the plot. Now I'll choose my actions or inaction on purpose." If you want more breakdowns like this, deep dives into how the plumbing of markets actually works beneath the headlines, hit subscribe, drop a comment with your thoughts on a potential silver squeeze, and share this with someone who still thinks metals are just dusty relics from their grandpa's time.